This is ESPP tax code, and this is the world's easiest ESPP tax graph that will take you from beginner to smarter than most CPAs on ESPPs in just a few minutes. I'm covering everything that you need to know, including examples, how to pay $0 in taxes, and most importantly, the common ESPP tax hack that actually breaks your taxes. Example number 1. If you sell for $20, your cost basis would be $850. You would have $650 worth of ordinary income reported on your W-2 and $5 of short-term capital gains to report. But how is this all calculated? Starting from the bottom, the cost basis is what you paid for the shares, which is not taxed. Above that is the ordinary W-2 income. In disqualifying disposition, that number is determined by looking at the purchase date, the date where your company actually uses your contributions to buy company stock. Any difference between the purchase price and the fair market value on the day of purchase will be recognized as ordinary W-2 income when you sell. So while there are no taxes for the purchase date, it's still important for calculating taxes. Fortunately, your W-2 income doesn't include FICA or Social Security and Medicare tax. This is one of the benefits behind qualified ESPPs, or Section 423 plans. Unfortunately, the ordinary W-2 income tax isn't always this easy to calculate. We'll address the other calculations in just a minute. But first, just know that for non-qualified ESPPs, which are less common, any spread between the purchase price and the fair market value is taxed on the purchase date as ordinary W-2 income. The last portion of your taxes due upon sale is anything sold within 1 year will be taxed at the short-term capital gains rates. That's what STCG stands for. But what if you sell for a loss? Let's say you sell your shares for $8. Your cost basis is still $8.50 because that's what you paid for the shares. The scary part is you still owe $650 in ordinary W-2 income. Why is this? This is because the IRS still views you as having had received a benefit from either the discount or look back on the purchase date. It seems kind of silly, but yes, you may still owe ordinary income tax even though you didn't technically receive any benefit. The nice thing about paying this tax is that it becomes part of your tax basis, meaning that you can now write that loss off against other gains, specifically short-term capital gains and potentially ordinary income on Schedule D. So in addition to your ordinary income of $650, you also get a short-term capital loss of $7 to offset current and future gains or income. But should you sell for a loss? I've got a video addressing these ESPP considerations that you can watch on my channel. But what if you sell after holding longer than 1 year? Well, for the most part, the rules that we just reviewed are the same, but instead of short-term capital gains and losses, it's going to be long-term capital gains and losses. Here's two quick examples. If you sold for $8, your basis would be $850 for the stock. You would owe $650 in ordinary W-2 income and have a long-term capital loss of $7. On the other hand, if you sold for $20, your cost basis would still be $850. You would owe $650 in ordinary W-2 income and $5 in long-term capital gains. Without a look back or a discount, you would just owe $5 in long-term capital gains. Up to this point, there hasn't really been a tax benefit besides the ability of choosing when to sell. But this is where the whole benefit behind qualified ESPPs actually begins. Ironically, this is where the tax break can actually break your taxes. This is hilarious because the whole purpose to qualifying disposition is to be a tax benefit. So did Congress actually achieve their objective by creating this law? Not exactly. Unless Congress did this hoping no one would notice. Let's start the tax conspiracy theories in the comment section. I'm kidding, just hit the subscribe button. You can actually pay more in taxes through the benefit of qualifying disposition. But first you need to understand the basics. If you hold your shares 1 year from the purchase date and 2 years from the first day of the offering period, then your taxes switch from short-term capital gains rates to the advantageous long-term capital gains rates. Except there's still one small portion that may be taxed at the ordinary income tax rates. Unlike disqualifying disposition, where we looked at the purchase date to determine the W-2 income tax, in qualifying disposition, we're going to look at 2 dates to determine the W-2 income tax. The amount of W-2 income tax due is calculated by comparing the lower number between these 2 dates, the discount on the first day of the offering period, or the actual gain, meaning the difference between the purchase price and the fair market value. It'll assign the lowest number between those 2 dates to be your ordinary W-2 income tax due. To help you with this, I've created a free ESPP cheat sheet that's available for download in the description. Before we dive into the tax hack that you'll regret, first a quick note on the offering period. All that's happening here is that your company is gathering contributions from each of your paychecks. And when your company pulls money from your paycheck, it's post-tax or after-tax, meaning the IRS taxes it, and then your company will pull it into their company ESPP escrow account. Here's where the ESPP glitch happens that can break your taxes. It's called the qualifying disposition trap. To determine the W-2 income tax, disqualifying disposition looked at the purchase date, while qualifying disposition looked at the first day of the offering period. Well, what if by chance there was a down market during the offering period? This would cause the stock price to be higher on the first day of the offering period and lower on the purchase date. So for disqualifying disposition that only looks at the purchase date, the W-2 income is lower. Whereas qualifying disposition that looks at the first day of the offering period, the W-2 income would be higher. Therefore, your W-2 income could be higher in qualifying disposition than it would have been in disqualifying disposition. This trap only exists if you have a discount or if you're in a down market. Said differently, this is only applicable if the price on the offering date is higher than the purchase date. Before we talk about the $0 tax bill, let's quickly address non-qualified ESPPs. Because there are no tax benefits in non-qualified ESPP plans, it's pretty simple. You only pay ordinary W-2 income up to the amount of benefit you received on the purchase date, for example, the discount. Then when you sell, it's just as if you purchased any regular stock, which would just be capital gains or losses. Also note that non-qualified ESPPs are subject to Social Security and withholdings. But how do the wealthy avoid paying capital gains tax? The wealthy use a strategy called equity monetization, which is beyond the scope of this video, but the one that I wanted to highlight takes the wealthy from a tax bill to a tax deduction in one simple trick. Rather than selling the stock, which creates a tax liability, you can donate the stock to a charity, which may create a charitable deduction. By donating or gifting your stock, you may be able to avoid the capital gains tax. So is the $0 ESPP tax bill actually a possibility? Yes, but only in some situations. Because even if you gift your ESPP stock hoping to avoid the capital gains, you still may be on the hook for the W-2 portion. The discount component could still be added to your taxable income in the year that you make the gift. Here's when the $0 tax bill is possible. If you'd like professional help to pull this off or see if this makes sense, my firm specializes in equity compensation like this, so if you'd like to work together, more information in the description below. The $0 tax bill is possible if there's an unfavorable look back or if your company doesn't provide an ESPP discount. Even if you meet those two requirements, it still might not make sense for you to gift to avoid taxes. For example, gifting the loss breaks the cardinal rule of estate and financial planning. Gifting losses forfeits your ability to harvest that valuable capital gains loss just by giving it away, when you could have sold, harvesting the capital gains losses, and then gifted the cash. While a $0 ESPP tax bill can seem really cool, there are some not cool tax things about ESPPs, such as double taxation, that I address in a separate video on my channel. But $0 tax bills and double taxation is actually a really bad place to start. There are 3 things that are more important than all the taxes I just showed you. Those 3 things are found in this video right here.